What if the biggest financial decision of your life isn't based on math, but on tradition? Since childhood, we've been handed a script. Rent is a waste. Owning is success. And the deed to a house is the ultimate proof that you've made it. Parents repeat it. Friends reinforce it. Real estate ads romanticize it. And if you're still renting past a certain age, you're behind. Not serious. Not building wealth. But what if the real mistake isn't renting? It's buying without questioning the numbers. Let's challenge the narrative. The real meaning of throwing money away. People say rent is wasted because the money is gone forever. But here's what rarely gets mentioned. A huge portion of home ownership costs are also gone forever. Mortgage interest in the early years, mostly paid to the bank. Property taxes, permanent. Insurance, ongoing. Maintenance, inevitable. Buying and selling fees, massive. In the beginning of a 30-year mortgage, the majority of your payment doesn't build equity. You're not paying yourself. You're paying interest. You're renting money. That cash never comes back. So if rent is waste because it disappears, what exactly is interest? The hidden cost structure of ownership. Home ownership has unrecoverable costs that people emotionally ignore. Interest, taxes, repairs, insurance, transaction fees. Add them up, and in many markets, the annual unrecoverable cost of owning looks shockingly similar to renting the same property. You didn't eliminate a landlord. You replaced one landlord with three: the bank, the government, and the contractor. The one metric that cuts through emotion. There's a simple calculation that removes the romance from this decision. The price-to-rent ratio. Take the purchase price of a home and divide it by the annual rent of a comparable property. Low ratio? Buying might make sense. High ratio? Renting is often financially superior. In many major cities, that ratio has climbed to levels where ownership comes at a steep premium. When the ratio stretches too far, you're paying extra for the privilege of owning, not gaining a financial advantage. Math doesn't care about pride. The down payment trap. Now, let's talk about the quiet wealth killer, the down payment. Imagine putting $100,000 into a house. That money becomes locked equity. It doesn't generate income. It isn't diversified. It's tied to one property in one location. If that same capital were invested in diversified assets, it could compound over time. Instead, it sits in drywall and concrete. When you buy, you're making a concentrated bet on one local market. Concentration increases risk. Diversification reduces it. That trade-off matters. Mobility is an asset. We live in a fast-changing economy. Jobs shift cities. Industries evolve. Opportunities appear unexpectedly. Renters can adapt quickly. Homeowners face agent fees, closing costs, timing risks, and potential losses if the market turns. Flexibility has value. Liquidity has value. Optionality has value. These rarely show up in home buying conversations, but financially, they're powerful. But rent goes up. Yes, rent increases, and a fixed mortgage can provide payment stability. That's the strongest case for buying. But ownership costs don't stay frozen. Property taxes rise, insurance premiums rise, maintenance costs rise. You're not escaping inflation. You're just facing it differently. Meanwhile, if the money saved from renting is invested wisely, those assets may grow over time, potentially outpacing rent increases. The comparison isn't rent versus mortgage. It's rent plus investing versus mortgage plus ownership costs. That's a very different equation. The lifestyle factor. Owning a home isn't passive. It demands time, attention, and responsibility. Broken heater? You pay. Leaking roof? You fix it. Market downturn? You absorb it. Renting outsources those risks. For some people, ownership pride outweighs the stress. For others, freedom outweighs control. Neither is morally superior, but only one should win. the option that fits your numbers and your life. The core wealth principle. Wealth grows from income-producing assets, businesses, stocks, bonds, assets that pay you. A primary residence usually requires you to pay it. That doesn't make buying wrong. It makes it a lifestyle purchase with financial implications, not an automatic investment strategy. The smartest move isn't following the script, it's running the math. If buying aligns with your time horizon, local ratios, and financial stability, buy confidently. If renting gives you flexibility, liquidity, and stronger investment growth, rent proudly. Wealth isn't about owning a house, it's about owning your strategy. If this challenged the way you think about renting versus buying, subscribe for more breakdowns that question financial myths and put numbers before narratives.